Hi everyone, this is Rohit Srivastava here. This is the 3rd of July 2016. We've ended a pretty interesting week, and I say that because after a very long time, we have seen almost all the assets, which is bonds, global bonds, equities, commodities, precious metals, uh, all of them end up closing the week up and together, and we've seen that even across the commodity pack. So essentially, you need to think about what this is telling us, and this month was not only about one event which is playing on everyone's mind, which is the Brexit vote, but there were two events, and the second one may have overshadowed the first one. The first one was essentially the Fed meet on interest rates, which happened mid of the month, and uh, after a very long time in expectation that there could be a second rate hike for this year, that was pushed forward, and because of weak economic data, the market started to anticipate that probably the Fed would not be able to go about doing it, and also that this is the last chance they would have, and probably if not in June, in July, before they themselves enter the election season. So in that sense, them having held back has been taken as a sign that probably they're starting to move towards lower rates. Now, before I dwell on that further, I must dwell on what is the single most meaningful impact that we had, or that we've seen from the Brexit vote itself. Because prior to the event, we did see equities sell off and then rally. So a day before the event, most markets had actually rallied, thinking that this wouldn't have gone the way it did, and then eventually they sold off again on fear that, well, it was going to be bad in the medium term. But again, we've seen a bounce back essentially in UK itself. So net, a lot of the US or India or UK, these markets at least are back where they were prior to the event. Some of the others have bounced back less, and similarly, even if you've seen a sell off in, say, crude, we've seen that come back. We've seen copper, which was down mid of the month, come right back up. What is the one thing which has actually moved most significantly because of this event and is still standing still? And when you think about that, it was probably the British pound. And so, apart from what might have been the geopolitical effect of what has just taken place, and the possibility that it would push maybe many other countries to move in that direction. If you think about the financial impact, the most single greatest financial impact on any market was on the currency market, and I think that's an important takeaway, because we are a couple of years into what has become a currency war, though a lot of people still don't call it that. And I've said this before, that in a free floating currency environment, uh, currency wars are not going to be fought the way they were in the old days, where you'd announce a devaluation. Currency wars are essentially taking place because of an actual move in the underlying price itself, and that we are seeing. We are seeing it happen one after the other, one currency after the other, and there was heightened tension essentially when the Chinese yuan started to be devalued a year back, and every time it moves beyond a certain threshold, it starts catching the attention of everyone, like it did a few days back again when it started making new lows. But again, no, it's not yet creating headlines. And that's the same with the pound. So the pound was essentially one of the lagging uh, currencies in terms of the devaluations that have been going on. And when you think about the event that took place a year back, which was Brexit, and then that was followed up by the yuan devaluation, you'd probably see linkages in terms of how each event is now desperately pushing currencies, because many countries, including India, which allowed its currency to now fall off way back in 2013. We were probably the early currencies to be devalued. Many others joined in 2014 and 15, and Chinese yuan was actually lagging behind, so they stepped in the pressure. And now, if you put it in that context, the pound essentially is the latest entrant into that move. And even though the USD GBP was going up, which means the pound was being devalued, it was moving up pretty slowly, which has also been the case with the yuan. And this event essentially led to a one-time big adjustment. And even after we've seen the bounce back in so many equity markets, we've not really seen the pound, start to appreciate again or correct again. In fact, last 2 days it has again started to weaken slightly, not making new lows yet, but it's something that you should continue to watch, because it has had a significant effect on the dollar. The dollar index essentially has been higher since it bottomed in April to May. And since that bottom, it is attempting to move higher, and it is not having any. I mean, in the last couple of weeks, instead of having a negative impact, it's actually, we've seen, like I said, all the asset classes actually moved up together, which was unusual because that's not the relationship they had in the past. We'd seen an entire year of strong dollar and weak commodities going on and on, and that trend came to a halt suddenly, and the reason most probably could be that we are beginning to cite that these movements would at some point of time push the US Fed also to start weakening the dollar. So people are starting to price in that, the QE4 or some form of future currency devaluation would also take place from the US itself. And that's been the one currency against which everyone has been devaluing. And so, uh, in effect, there's no net real gain that anyone really gets from doing this. But once the US steps in and starts to devalue, then it's a very, very different ball game, because then you start getting a falling dollar, and it definitely supports the recent run-ups that we are seeing in commodities and precious metals. But the big question is, has that move started? Because I too was bearish on the dollar in Jan and Feb, and that drove my view in a bounce back in commodities and gold and so on, and that played out. But more recently, I've been looking at an up move in the dollar that has happened, and the market has started to appear, started to anticipate the next leg down. However, the dollar itself has not moved. So if I actually look at the daily, weekly, or monthly indicators, the momentum indicators, they are all still not turned from the buy side to the sell side. They've not crossed back down. And so in that sense, momentum itself is not indicating that there's been a trend reversal in the dollar. You can argue wave wise that you can complete three waves here, but it's not very clear, because you haven't seen an impulsive sell off, and so you cannot really rule out that the current wave continues to extend higher. If I look at what the GBP is doing or what the CNY is doing, I would essentially expect that the move up would continue, even if I look at all the multiple dollar pairs. So the point of this is that while we are seeing some strength in the USD INR, that is basically the rupees appreciating, we are seeing significant appreciation in the Brazilian real for completely different reasons. As there are a lot of geopolitical events that have happened there. But if you continue to see a rising dollar in most other pairs, uh, I don't know how long we can continue to expect the INR to keep appreciating without having a significant negative rub off, because it's been pretty long period that we've because we devalued early, it made sense to hold back for this long while the whole world was going through a devaluation. But if you go through another round of that in the dollar, and it would happen if the pound starts to fall further, I don't think the euro would hold back. So the European Union may be pushed to thinking of further stimulus to push down the euro. And if that happens, what stops Japan from coming in with something new to restart what it had a couple of years ago? After all, you've seen the yen go up, weaken a lot. That is, the USD JPY go up a lot and retrace more than 50% of those losses that it made. And in that sense, it's given back a lot of what it was gaining for that economy in terms of inflation. And they may decide to start that all over again. And if that's another round that we are going into, then the USD and R can't simply keep holding back, and that could become one of the headwinds for our own market. So the currency wars don't seem to be over. I think that's the biggest takeaway from the Brexit. It's more a currency event so far. Everything else is still a discussion and will continue to be discussed, and steps would be taken in that direction. Will Brexit become a reality or not? No, we don't know. It's something we can keep debating. It looks like it would, but we saw that with the Greek exit itself, that the vote that was made by the public at large was not really adhered to. The parliament rejected it. And so you can speculate whether something similar would happen here, even though most people are going on record saying that it will not. It is likely to be a long period of discussions and debates in terms of what are going to be the terms and conditions of the new regime. So in that period, the biggest I think financial impact that we've had, like I said right at the beginning, has been the weakening pound, which means the currency war part continuing, and everything else are just moving parts which continue to go on. And so that's something we'll have to pay attention to for our own market as well as the USD and are going to respond to a rising dollar. If the rising dollar continues in that direction, then we will see that response. The next thing that I would like to highlight is that while we've seen this continued move across these asset classes, we've reached certain sentiment extremes in some of them, and become pretty much across the board. So you remember in Jan, when we was looking for a bottom, and I thought Indian market would respond to what was happening around the world, but we continued to fall till our budget. But most global markets and commodities and the dollar actually turned between Jan and Feb itself. In the early part of Feb, by the first week of Feb, most of the reversals were done, which means you had you'd gone into a period of a falling dollar. You had a rebound in commodities. Gold and silver moved up, and most global equities moved up. And you had extremes, basically extreme selling sentiment in commodities. Crude had record short positions. So what you're witnessing now after a 4-month rally is the complete opposite of that, which means that you have record long positions in gold and silver, even as they continue to run up against that data point. And it's possible they do have some more upside because their sentiment readings in terms of the daily sentiment index surveys has still not reached significantly beyond the 90% mark. But the positions are record. In silver, they are way higher than what they were in 2011. What makes that more significant is that it's not just in gold and silver, but it's also in commodity futures as a whole, that the futures uh, commitments to the long side by traders have reached a record, meaning that they're at the same or higher levels as compared to three previous occasions: the 2008 high, second the 2011 high, and third the 2014 high, from where crude actually started its major sell-off. Even though commodities were down between 2011 and 14, there was some rebound at that point of time, and long positions had reached the same excess level. So this is the fourth occasion that we are seeing commodity futures positions reach this extreme across the board. And that's telling us something, that the rally we are seeing in copper, aluminium, gold, silver is pretty much become an extreme across the board, crude included, because crude too, I was expecting it to hit and probably top out close to the $50-51 mark, and it has halted there. It closed negative for the month, indicating that probably this move is complete. It has stayed in this range. It is not really sold off. It often lags the commodity market, but that we have record positions is something that you should take note of. And the most important record position that we are hitting, and there's been a note out by EWI itself pointing to it, is in the bond market. The last time there was such a warning was in 2013 when the 10-year US bonds actually peaked and sold off. And if I just look at the price rate of the 10-year bond, it's really not made a new high. So we have this big intermarket divergence now between the 10-year and 30-year, because the 30-year has continued to make new highs as it appears to be in what would be an ongoing long-term multi-decade bull run in the 30-year US bond. But the point I'm trying to make is that US bonds have reached a sentiment extreme, both in terms of the daily sentiment index readings and the commitment of traders, which is published by the futures market for the US. And that commitment of traders has reached a record level, way higher than it's ever been before, and that points to the potential end to what has been an ongoing risk off trade in, or a safety trade in buying the long bonds. And it's also been one of the biggest drivers of the dollar. So that too points to, well, to stay a little alert on the dollar risk. So while I'm saying that, yes, we can see a continued rise in the dollar for a while, a sell-off in the bond market could eventually put pressure on the dollar itself. So we are in the final legs of what is a dollar rally. It's not clearly over. But what we are seeing in commodities and bonds is the potential for an across the board reversal, which again would be a very, very unusual event, because that means you're talking about interest rates starting to spike up along with commodity prices heading lower, which is not something which you normally expect. But the extremes that are being reached are pointing to that for whatever reason it may be. So what would that mean for us? I've talked of two things. One is the risk that USD-INR actually moves up, even though it's corrected recently. It's been range bound for a while. It keeps finding support close to the 67 or lower levels, and it keeps facing resistance the moment it tries to go close to the 68 mark. But at some point of time, it's possible that it starts off a rally that takes it higher, because it's been suppressed for so long. And if that is accompanied by a jump in US yields, even in 2013, when we saw our own yields shoot up, it was essentially because the 10-year had peaked and was selling off sharply. And this time around, if you get the 30-year selling off sharply, then it would be a major wave again down in US bonds. That time it was, of course, the taper tantrum. This time we don't know what it's going to be. That's something that we'll only know in hindsight when you get news. But the setups are for that kind of a reversal to happen, which means higher dollar and higher rates is what the market data, the technical data, is essentially pointing towards. And then to come, to close this by looking at the Nifty, essentially what happened with the Brexit sell-off and the rally subsequently is that all the moves that we've got from the late Feb or early March bottom, the market has rallied, not for more than a week, 5-6 days at the most, and then after that it goes dead into a sideways mode for several weeks. We've seen that happen again and again, and the same has probably repeated this week. We've had a 1 week big run, and each of the moves that have occurred have overlapped with the previous moves, which means after each move up, whenever there's been a correction, it's gone back and overlapped with the previous move. And therefore, it's not possible to count a completed impulse wave to this entire rise. In fact, and the easiest thing to do is to mark it as a corrective, which is something like an ABC, XABC, or multiple alternate patterns that you can come up with. But essentially, because it's overlapped, it does not make up for a impulsive structure. And even though I was not expecting that we would get past maybe the 8250, 8280 range, because these were big retracements. So essentially, we retraced 50% of the bear market from last year at 7980 in May. Then we got past that and we hit 8250, which is 61%. And now we are very close to the 66% mark, which is 2/3 retracement at 83 approximately. We are still below that, although intraday we did go a little above it, but we are still closing below that, and in that sense we remain at two-thirds retracement both for Bank Nifty and Nifty, and remain in what continues to appear like a corrective or counter trend, but of a larger degree, because after a 4 quarter decline we are essentially making almost more than a quarter rally now in the market. And having done so, what we have continued to see is this continued strength in the mid and small cap segment of the market, which is at a level which keeps telling me that it could be getting extremely dangerous. There is the potential for major sell-off if the markets do reverse trend from here. The mid and small caps always get hurt hard. It did not happen last year. We got a 1 year decline in the Nifty, which was which did not see a significant sell-off on a relative basis to the mid cap segment, like we've seen in previous bear markets, and the relative strength only peaked in December or Jan of this year, and now is making lower tops even as these indices are again racing to get past each of their swing highs. In fact, the BSE mid cap index has become the first index to essentially make a new record high. And so it's gone past all the highs of last year. The others are still not there, but it's become the first. And therefore, it continues to indicate that strength has remained in the broad market, even though it has not been there in the large cap segments of the market. So that's all in this update. I've highlighted, that the move continues to look counter trend. The risk remains in major in bonds, commodities, and you need to watch out for the impact that would have on our own currency and bonds. And the rally being counter trend, whenever it turns down, would carry maximum risk to the mid cap. So that's what my conclusion is with all the movements that we've seen. And the bounce that we've seen going beyond the pre-Brexit highs is completely normal, because whenever you get event-based sell-offs, more often than not we've seen the market bounces back to take out those highs. So in that sense, it's not unusual to have happened, but what's important to watch is what happens from here. That's all. Thank you.